Welcome to the deep dive. Today, we're really digging into the core principles of investing.
And we've got a fantastic guide for it.
Absolutely. Benjamin Graham's The Intelligent Investor, plus some great commentary from Warren Buffett.
Yeah, it's a classic for a reason.
Our goal today, for you, the learner, is to pull out the really crucial, lasting lessons from this text.
We want to give you a solid way to think about investment decisions, without getting swamped by all the market noise.
Exactly. So what sources are we working with today?
Well, we've got a good mix. We're looking at chapters covering the investor's mindset, inflation, a bit of market history focusing on 1972,
Okay.
and then portfolio strategy specifically for the defensive investor.
And layered over that, we have Buffett's commentary.
Right, his thoughts on those chapters, plus various examples scattered throughout the book that really illustrate the core concepts.
Perfect. So whether you're maybe prepping for a meeting or just wanting to get a firmer grip on investment fundamentals,
Or even just curious about building some financial understanding.
this deep dive is definitely for you. We're aiming for those aha moments, making complex stuff clear and showing what really counts in the long run.
All right, let's jump in.
Okay, so the absolute foundation, according to Graham, it's about having the right framework, right? And keeping your cool.
Exactly. It's these two things. A sound intellectual framework for making decisions and, crucially, the emotional discipline to stick with it.
He argues you don't need to be a genius or have inside info, does he?
Not at all. He explicitly says successful investing over a lifetime doesn't demand extraordinary intellect, business insight, or secret tips.
It's more about having that logical plan.
Right, that framework. Graham's book gives you that.
And our job, the learner's job, is to bring the emotional stability.
To prevent emotions from wrecking that carefully constructed framework.
Buffett really hammers this home too, doesn't he? Especially chapters 8 and 20.
He does. He says if you follow Graham's business principles and those behavioral guidelines in chapters 8 and 20, you should get satisfactory results.
Which, in investing, satisfactory is actually pretty good, isn't it? Consistent returns.
It's very significant. But if you're aiming higher for extraordinary results,
Then it takes more.
that's where your own effort, your intellect, and, crucially, taking advantage of market irrationality comes in.
So turning the market's craziness into an opportunity.
Exactly. The more irrational the market gets, the more chances there are for the investor who thinks like a professional, who follows Graham.
So you benefit from the madness instead of being caught up in it.
Right. You use Graham principles to profit from folly rather than participating in it.
I like that. And Buffett also mentions Graham's writing style was quite understated.
Yeah, very much so. No exaggeration, no lecturing, no conceit. Which is pretty amazing given how powerful his ideas were, and still are.
40 years later, it's still the go-to text for value analysis.
Absolutely. Buffett says it's hard to even name a clear second place. Graham's ideas have weathered financial storms that just flattened other, more flimsy intellectual structures.
And his advice actually worked for people.
Consistently. Even for folks who weren't maybe natural finance whizzes, they often did better than professionals chasing the latest fads.
Okay, so we've got the framework and the need for emotional control. What about the common mistakes Graham helps us avoid?
Well, one big one is thinking that just because an industry looks like it's going to grow like crazy,
Like, say, airlines back in the day.
exactly like airlines, obvious physical growth doesn't automatically mean obvious profits for investors. The economics of the industry matter hugely.
Right. Competition, costs, that can eat up any potential investor gains.
Precisely. And Graham also points out that even the experts, the professionals, they can't reliably pick the best companies in the hottest sectors and just pile in.
So that whole strategy of betting big on the next big thing is flawed.
Graham didn't do it himself. He didn't believe you could consistently win that way. You should never assume one industry is just guaranteed to beat all others forever.
Makes sense. And Buffett says a lot of losses could have been avoided just by sticking to these principles.
A huge amount. He quotes Graham saying, "Enthusiasm. On Wall Street, it almost invariably leads to disaster."
We saw that with internet stocks, didn't we? Pure enthusiasm detached from reality.
Absolutely. Letting emotions take over, whether it's tech stocks then or maybe growth stocks now, it just leads to repeating old mistakes.
People let others' opinions override their own judgment.
And they forget to ask the most basic question, how much does this cost?
That's when the really frightful losses happen, as Graham put it, when price becomes irrelevant.
Yeah, it comes back to that core idea. The investor's primary problem, their worst enemy, is often themselves, their emotions.
Buffett gives some pretty stark examples from the late 90s, early 2000s crash.
Oh, yeah. The Marindo Technology Fund, huge promises, then a massive collapse. Monument Internet Fund, same story.
Even well-known commentators got caught up.
He mentions James Cramer's picks back then, which also led to big losses for followers. It just hammers home Graham's warning.
That obvious prospects for physical growth do not translate into obvious profits for investors.
Right. Spotting a growing sector is easy. Making money from it requires buying at the right price. That's the hard part.
Okay, this leads perfectly into the difference between investing and speculating. How does Graham define that?
Well, from his quite conservative standpoint, if you're a non-professional and you're operating on margin,
Borrowing money to invest.
yes. That, for Graham, is speculating. Full stop.
And buying those hot stocks everyone's talking about.
That's speculation too. Or maybe just gambling.
So if you do want to speculate,
His advice is clear. Set aside a small, separate amount of money specifically for that. A speculation account.
and don't add more just because the market's going up and your bets are working.
Absolutely not. Keep it strictly limited and separate from your serious investment capital.
That separation seems really important. He also touches on arbitrage, right?
Yeah, briefly. Those opportunities to profit from tiny price differences, they used to be more accessible.
But not so much anymore for individuals.
Pretty much gone, Buffett says. You need huge transaction sizes now, so it's really the domain of big institutions.
Got it. Okay. Framework, pitfalls, investment versus speculation. Let's talk inflation. How does that fit in?
Graham's historical look found something interesting. In years where prices actually fell deflation,
You'd think that's good, right? Lower prices.
and counterintuitively, stock returns were terrible in those deflationary periods.
Huh. Why is that?
It seems deflation often goes hand in hand with broader economic weakness, falling corporate profits.
Okay. And what about high inflation?
Also bad for stocks, generally. When inflation got above 6%, stocks often declined too. The market actually lost money most of those high inflation years.
So extremes are bad. What about the middle ground? Moderate inflation.
That seemed to be the zone where stock market gains were possible, kind of a Goldilocks scenario maybe.
And Buffett stresses looking beyond the headline return numbers.
Absolutely. Those nominal returns, the interest rate advertised, the percentage gain can be really misleading.
Because inflation eats away at your purchasing power. Your real return is what matters.
Exactly. You have to measure success by what you keep after inflation.
And Buffett warns against thinking inflation is dead right. He gives reasons.
He does mention there are reasons inflation might not be gone for good, though the specifics aren't in our excerpts today. The key point is it's a risk investors need to keep in mind.
And he mentions a specific tool to help with that, TPS.
Right. Treasury inflation-protected securities. U.S. government bonds.
How do they work?
Their principal value adjusts automatically based on the Consumer Price Index, the main inflation measure.
So they protect against both losing money and losing purchasing power.
Pretty much. Since they're backed by the U.S. government, there's minimal default risk, and they have that built-in inflation protection. A good tool for defensive investors worried about inflation eroding their savings.
Okay, that's useful. Now, shifting gears a bit, learning from market history without just blindly following past trends, what's Graham's take?
He was very strong on this. Do not predict the future just by extrapolating the past.
But that's exactly what happened in the 90s, wasn't it? With Dow 36,000 and all that.
Exactly. Buffett points out how many experts made that mistake. They saw strong past returns and just assumed they'd continue forever.
Books like Stocks for the Long Run kind of fueled that.
They did, leading to these wildly optimistic targets, Dow, 36,000, 40,000, even 100,000, all based on this flawed idea that stocks always returned, say, 7% after inflation, going way back.
But the data from way back wasn't reliable, was it?
Not at all. Buffett highlights that before 1871, the early U.S. stock indices had like 7 stocks.
7. That's tiny.
Yeah. Meanwhile, there were hundreds of companies, many in new industries. And guess what? Most of those early companies failed. Wiped out investors.
So looking only at the few survivors from a tiny sample gives a totally skewed picture.
Massively skewed. Overly optimistic. It feeds into that classic investor behavior.
Buying high when everyone's euphoric, selling low when panic sets in.
The exact opposite of what you should do, Graham warned. The more wildly optimistic investors get about the long term, the more likely they are to be wrong in the short term.
And the 2000-2002 crash was a brutal lesson in that.
Absolutely. Trillions lost. And then, interestingly, Buffett notes that during that crash, many commentators swung the other way, predicting flat or negative returns for decades.
So don't let the recent past, good or bad, dictate your whole outlook.
That's the key takeaway. Maintain perspective.
Okay, so we need the framework, the discipline, awareness of pitfalls, inflation, market history perspective. How do we actually build a portfolio? What's Graham's advice for the defensive investor?
He stresses that your allocation, how you split your money, depends on your own circumstances. Age, finances, risk tolerance, all that.
Makes sense. But is there a general guideline?
Yes, he recommends a balanced approach, a mix between high-grade bonds and high-grade common stocks.
Safety from bonds, growth potential from stocks, what kind of split?
A simple starting point, he suggests, is 50-50. Keep half in bonds, half in stocks.
And then rebalance?
Yeah. If the market moves and, say, stocks become 55% of your portfolio, you sell some stocks, buy some bonds to get back to 50-50, maybe rebalance when it shifts by about 5%.
It enforces discipline. Sell high, buy low, automatically.
Exactly. He also offers a slightly more active approach.
Like adjusting based on market levels.
Right. Maybe reduce stocks down to 25% if the market seems dangerously high, or increase them up to 75% if a big drop makes stocks look really cheap.
But based on overall market valuation, not just trying to time specific stocks.
Correct. And Buffett adds a crucial point here. Don't change those target percentages just because the market moved yesterday or you feel nervous.
Only change them if your life circumstances change, like nearing retirement.
Exactly. Or your fundamental risk tolerance changes, not based on market whims.
It's discipline over emotion again?
Yeah.
Buffett's quote, "Don't buy more stocks because the market went up. Don't sell because it went down."
Perfect summary. He even suggests putting your retirement plan rebalancing on permanent autopilot to avoid those impulsive moves. Just stick to your target, say 70% stocks, 30% bonds, and adjust periodically.
And for the bond part, Graham generally liked bond funds for individuals.
Yeah, for most people. They give you diversification right away, monthly income, easy reinvestment. Buffett agrees, saying funds are usually more practical than picking individual bonds, unless maybe you're buying U.S. Treasuries or some tax-exempt municipal bonds.
Okay. Now, within this portfolio, the idea of risk is key. How does Graham view stock risk versus bond risk?
Well, the traditional view is bonds are safest, then preferred stocks, then common stocks are riskiest, which leads to this bias against stocks.
People think stock's unsafe.
Often, yeah. But Graham points out that risk and safety mean different things here, causing confusion.
Also,
Well, bonds might seem safer because their price doesn't usually swing as wildly as stocks in the short term. That's one kind of safety.
less volatility.
Right. But the risk with bonds, especially long-term, is inflation eroding your fixed return, or the issuer defaulting, though less likely with high-grade ones.
Okay. And stocks?
Stocks are more volatile, sure. Their prices jump around, that's a risk. But over the long haul, a good stock portfolio has the potential to significantly outpace inflation and grow your purchasing power. That's another kind of safety, long-term safety.
So, short-term price stability versus long-term purchasing power protection. Different kinds of risk and safety.
Exactly. And Buffett adds that it's become way easier and cheaper now for defensive investors to own stocks, especially through index funds and automated plans. Building a diversified stock portfolio is much simpler today.
That ease of access brings up another popular idea. Buy what you know. What did Graham think about that?
He was cautious about it. He warned defensive investors not to think they can pick winning stocks just because they like a company's product or service.
So, liking Starbucks coffee doesn't automatically make Starbucks stock a good buy for you.
Right. Peter Lynch made that "buy what you know" slogan famous, suggesting amateurs had an edge with familiar companies. But Graham's view is more critical.
Why?
Because while your experience as a customer might give you an idea, it's no substitute for proper financial analysis, due diligence.
Familiarity can breed complacency. You might skip the hard analysis.
Exactly. Buffett warns about that specifically. The more familiar it feels, the bigger the risk you get intellectually lazy. Don't let that happen, he says.
But he also says it's a golden age for stock ownership now.
For the defensive investor willing to do the work, yes. Because it's so easy and cheap to invest thoughtfully today. Access is unprecedented for you, the learner.
That's encouraging. Okay, let's talk about new things coming to market. New securities, IPOs, Graham's advice.
He points out that companies usually issue new securities, bonds, stocks when conditions are good for them, the sellers.
Meaning they can get a good price.
Often, yes. Which doesn't necessarily mean it's a great deal for you, the buyer, especially individual investors.
Institutions can look after themselves, but individuals might overpay.
That's the risk. You get caught up in the novelty or perceived safety, and pay too much, leading to poor returns later.
And IPOs, initial public offerings, even more caution needed there.
Definitely. Graham talked about the madness that can surround IPOs. That lure of quick, huge gains is strong.
But often followed by big losses.
Very often. Buffett mentions Aetna Maintenance from 1961 stock soared after the IPO, then crashed. Lots of people who bought into the hype lost money.
The idea of getting rich quick on IPOs seems dangerous.
Buffett calls it a toxin that infected people in the 90s bubble. Yes, some IPOs like Microsoft were huge long-term wins.
But they're the exception, not the rule.
Absolutely. People extrapolate those rare, huge successes and think it's common. It's a very human, but very misleading tendency in investing.
So, extreme caution with new issues and IPOs. Okay, what about market timing? Trying to buy low, sell high by predicting moves.
Graham is pretty blunt. Trying to time the market's short-term swings is unlikely to work for the average investor.
It's just too hard to predict consistently.
Way too hard. He believed it's beyond most individuals, and even most professionals. Don't base your strategy on it.
But what about benefiting from big swings after they happen, like buying after a crash?
That seems more logical, maybe. Buying after a big drop, selling after a big run-up. But Buffett notes even that has gotten harder in recent decades. Markets are faster, more efficient.
So it requires a level of intuition and decisiveness most people don't have or shouldn't rely on.
Pretty much. Graham's core advice stands. The intelligent investor must never forecast the future exclusively by extrapolating the past. Don't try to time it based on recent trends.
Okay, no market timing. What about the hunt for growth stocks, companies expected to outperform? Graham's view.
He gets why people want them. A growth stock is usually one that's grown fast already and is expected to keep growing fast. It's an understandable goal.
But there's always a but.
But just focusing on past growth isn't enough for intelligent investing. You can't just project the past forward indefinitely.
Because sustained high growth is rare and hard to maintain.
Exactly. Buffett points out even smart managers often underestimate how hard it is. Competition, market changes, limits to growth. Things happen.
So the intelligent investor doesn't just chase the popular high-priced growth stocks?
No. Instead, they might look at growth companies when something goes wrong, when they become temporarily unpopular.
Like Buffett's Johnson & Johnson example from 2002. A counting probe hit the stock.
Precisely. J&J was still a great growing company, but the negative news made it relatively unpopular, as Graham would say. That temporary dip created a potential buying opportunity for a long-term investor.
So look for good growth companies when they stumble, not just when they're soaring and expensive. Be wary of the height.
That's the essence of it. Find value even within growth, often when others are pessimistic.
All right, let's revisit speculation versus investment again, thinking about the overall market level.
Right. Everyone should be aware that market levels change, and it's natural to want to benefit from market movements, usually through long-term gains.
But that desire can lead you down a slippery slope towards speculation.
It carries that risk. You can start acting like a speculator without even realizing it.
And Graham's advice on speculation is the same regardless.
Absolutely. If you choose to speculate, know the risks, limit the amount strictly, and keep it completely separate from your real investment program. That mental and practical firewall is crucial.
Be honest with yourself. Okay, now for one of Graham's most famous ideas, the Mr. Market analogy. Can you walk us through that?
Sure. Graham suggests thinking of the stock market as your business partner, this fellow named Mr. Market.
And he shows up every day.
Every day. And he offers to either buy your share of the businesses you own or sell you his share. And the prices he quotes are all over the place.
PC's moody.
Extremely moody. Some days he's euphoric, offering you crazy high prices. Other days he's deeply depressed, offering rock-bottom prices, maybe even begging you to sell.
And his prices don't always reflect the actual value of the business.
Often they don't. They're driven by his emotions, fear, and greed, not by rational analysis of the business's long-term prospects.
So what should the intelligent investor do with Mr. Market?
Take advantage of him when he's being irrational. Use his pessimism as an opportunity to buy good companies cheap.
But don't feel obligated to trade with him, and definitely don't let his mood affect yours.
Exactly. You're in control. You don't have to accept his offers. And you certainly shouldn't let his manic depressive swings dictate your own investment decisions.
So long-term success depends on the business, not Mr. Market's daily vote.
Fundamentally, yes. It's about the company's results, its profits, its growth in real value over time, not Mr. Market's often fickle daily price tag.
Buffett's Into My example illustrates that, well, right, huge price based on
Yeah.
hype, then collapse even though the business still existed.
A perfect example of the disconnect between Mr. Market's price and the underlying economic reality of earnings power. Price is not value, especially short term.
Great analogy. Now, many people invest through funds. What are some key things Graham points out about investment funds?
Well, most funds have just one type of share, but some newer, more complex ones split things up, like income shares and capital shares with different claims.
And things like hedge funds.
Buffett mentions those are usually for wealthier investors. High minimums, not really accessible for most individuals.
What about fund costs? Loads.
Right. Sales commissions or loads can take a bite out of your investment right at the start. A front-end load comes off the top before your money even buys shares.
Graham was a bit cynical about how those are presented.
Yeah. Buffett notes, Graham thought the way commissions were sometimes calculated was a bit of a sales trick to make them look smaller. Thankfully, no-load funds without those upfront fees are much more common now.
Good news. And taxes on funds, how does that work?
Most are regulated investment companies, or RICs. They avoid corporate tax if they pass almost all their income and gains through to shareholders.
So no double taxation, generally.
Generally, no. The fund distributes dividends, interest, capital gains, and you, the shareholder, pay the tax on those distributions.
And those capital gain distributions.
If the fund held the asset for over a year, the distribution is usually taxed to you as a long-term capital gain, often at a lower rate.
But Buffett warns about buying funds late in the year.
Yes. Avoid big purchases in, say, November or December. You could end up getting taxed on gains the fund made before you even own shares if they distribute them at year-end. A really useful tip.
Definitely. Now, what was Graham's overall view on funds versus individuals picking stocks?
He saw the reality for many people wasn't choosing between a perfect DIY portfolio and a slightly pricier fund.
It was more like choosing between a fund salesperson and maybe something worse.
Right, like getting lured into dodgy IPOs or other speculative ventures. So in that context, a decent mutual fund could actually be a less speculative, more disciplined option for some investors. It offers built-in diversification and avoids some temptations.
Interesting. So if someone decides funds are the way to go, how should they choose? What factors matter?
Graham noted the evidence on predicting future fund performance from past results is shaky, often contradictory.
So chasing last year's winners isn't reliable.
Not really.
Yes.
Strong past performance, especially in a bull market, might just mean the fund took huge risks that could backfire later.
Okay. What should you look at then?
Buffett stresses costs, fund expenses, the operating costs, the trading costs inside the fund. They really add up and eat into your returns over time. Lower costs are generally better.
And big funds might get cautious. Sheep-like behavior.
Yeah, as funds get huge, managers might just follow the herd to protect their fee income, rather than making bold moves that could lead to better returns but also carry more risk of underperforming benchmarks short term.
So look at the expense ratio. What else?
Buffett suggests checking the fund's risk profile. Maybe look at its worst quarterly loss in history to get a feel for the potential downside.
And Morningstar ratings.
He recommends considering them. They give an independent assessment of performance, risk management, a broader picture than just raw returns.
Okay, so costs, risk, independent ratings. Now, for those who do want to analyze individual stocks, what's the role of security analysis?
Graham believes strongly in it. He thought many Wall Street analysts could be more helpful if they focused on finding intrinsic value for the long-term investor, not just predicting short-term price moves.
Aligning analysis with the investor's goal of building wealth based on fundamentals. Where does that analysis start for someone newer?
Often, it starts with reading and understanding the company's annual report, its financial statements. Graham wrote a whole separate book on that, The Interpretation of Financial Statements.
But the intelligent investor focuses more on principles.
Right, principles and attitudes. But he does outline key criteria for analyzing common stocks.
Like what?
Things like adequate company size, strong financial condition looking at debt levels, current assets versus liabilities, earnings stability over time, a history of paying dividends, and the current dividend rate. It's a checklist for fundamental quality.
A way to assess the health of the business itself. How about valuing the stock? Determining what it's worth.
The core idea is to estimate an intrinsic value you can compare to the market price.
How do you estimate that?
Typically, you estimate the average future earnings over several years, then multiply that by an appropriate capitalization factor.
Which is basically the price to earnings ratio the market assigns, how much it values each dollar of earnings.
Exactly.
Yeah.
Graham suggested a two-part method. First, calculate a past performance value based only on historical data profits, stability, growth, financials.
A baseline value based on the track record.
Right. Then the second part is to adjust that value based on any significant new conditions or reasonable expectations about the future.
But be careful not to get carried away with future predictions. Anchor it in the past.
Very much so. He stressed conservatism. Rely mainly on the demonstrated record. Make only modest, well-supported adjustments for the future. Ground it in reality.
Makes sense. Now, earnings per share, EPS, is a key number. Any warnings about using that?
Yeah, don't take a single year's EPS too seriously. It can jump around a lot.
Look out for catch-for-suckers items. What does that mean?
Things like big one-time charges or special gains that distort the underlying recurring profitability. You need to look past the headline number.
So how do you get a better picture of earning power?
Use an average. Graham liked averaging earnings over a longer period, maybe 7 to 10 years. That smooths out the bumps and gives a more reliable idea of sustainable earnings. It implicitly accounts for those special items over time, too.
A longer view gives a clearer picture, and Buffett adds a warning about accounting changes.
Crucial point. Companies can change how they account for things, and that can significantly impact reported earnings, sometimes making things look better than they really are.
Like the Global Crossing example.
Exactly. It highlights why investors need to understand the accounting, not just the numbers. Are the numbers reflecting reality?
Good point. Graham used some specific examples around 1970 to illustrate this. Emerson Electric, Emory Air Freight, LTRA, M-Hart. What were the lessons?
Looking at those really showed the importance of digging into profitability metrics like return on book value, operating margins plus earning stability and growth. It's not just about revenue.
And valuations mattered. Emerson Electric had a high market value.
Right. Buffett compares that to Zenith Radio, later great history, but profits fell, stock crashed. The lesson. Even great companies are risky if you overpay. Past success isn't a guarantee.
What about Emory Air Freight? Great growth prospects then.
Yeah, but a sky-high PE ratio, over 60. Graham's point, growth potential is fine, but you have to consider the price. Speculating just on growth, ignoring valuation, isn't intelligent investing. A really high PE needs extraordinary justification, not just hype.
Price always matters, even with growth. Okay, let's talk stock splits. Do they actually create value?
Fundamentally, no. A stock split just means more shares, lower price per share. The total value of the company and your holding stays the same. It's like cutting a pizza into more slices. You have more pieces, but not more pizza.
But didn't people get excited about them in the dot-com boom?
Totally illogical, Buffett says. Speculators treated splits like they inherently increased value. A split announcement could actually boost the price just based on that misunderstanding. Shows how psychology can warp things.
More slices, same pizza. Okay, pulling things together. Graham had specific criteria for defensive stock selection. What were they?
That's a pretty rigorous checklist. Adequate company size, strong financials, current assets at least twice current liabilities, manageable long-term debt earning stability, meaning no losses in the last 10 years, a consistent dividend record, including a current dividend.
And crucially, limits on the price.
Yes. Price not more than 25 times average earnings the last 7 years, and not more than 1.5 times book value. Though a lower PE, maybe below 15, could justify a price to book slightly over 1.5.
Pretty strict. Did many stocks meet that back in 1972?
Relatively few, actually. But some big solid names did, like AT&T and Standard Oil of California. They were available at prices that met his definition of reasonable.
And his basic rule of thumb for the portfolio?
The overall earnings yield of the stock portfolio, that's earnings divided by price, the inverse of the PE ratio should be at least as high as the interest rate you could get on high-grade bonds. Stocks should offer a comparable or better return potential for the risk.
Makes sense. Now, the absolute cornerstone, margin of safety, what's the core idea?
It's about not investing based on predicting next year's earnings. That's too dangerous.
Instead,
Use a more stable earnings base for valuation. Graham liked using the average earnings of the last 3 years when calculating a PE ratio, current price divided by 3-year average EPS.
grounding it in recent, but not just immediate, history. And Buffett noted that even in 2003, quite a few S&P 500 stocks met Graham's value criteria, like a PE under 15 based on average earnings.
Yes, showing the principles still find opportunities. And this links back to why safety is needed. Very few companies maintain super high growth forever. Even the best have ups and downs.
So the margin of safety is buying significantly below your estimate of intrinsic value, a buffer for error.
Exactly. It's protection against mistakes in your analysis or just bad luck, unforeseen events. You build in a cushion.
And diversification works with this.
Absolutely. Diversification is key for conservative investing. It spreads the risk. Margin of safety protects you on individual picks. Diversification protects the overall portfolio.
Buffett's line, no good or bad stocks, just cheap or expensive ones.
Right. Even the best company is a bad investment if the price is too high. Even a troubled one can be a good buy if it's cheap enough, offering that margin of safety. You can even find it in undervalued bonds sometimes.
Value is relative to price. Always need that buffer. Okay, what about the enterprising investor, someone aiming higher than the defensive approach?
Graham admits beating the market is hard, even if you're knowledgeable. But if there are segments of the market that analysts often overlook, the intelligent, enterprising investor might find undervalued gems there.
Looking where others aren't.
Kind of. Focusing on secondary companies, solid businesses, maybe making a good impression now, but not popular with the crowd. Like LTRA and M-Hart back in these 1970 examples.
How would you find those?
Graham suggested using tools like S&P's Stock Guide, screening for criteria like financial strength, earnings stability, dividends. Growth may be slightly less strict criteria than for the defensive investor.
So more research required, looking beyond the big names. He ran experiments on simple strategies too, like just buying low PE stocks.
He did. Tested single factors like low PE, high dividend yield, etc. starting in 68. The results by 71 were mixed. Showed it's complex. No magic bullet.
And popular large companies can stay expensive.
Yeah, those impressive performance records often have momentum. Both real quality and popularity keep their prices up, even if they look pricey by the numbers.
So no easy answers even for the enterprising. How might someone look for these opportunities today?
Buffett suggests using modern tools, websites like Yahoo Finance, Morningstar to screen stocks using Graham's criteria. That can generate ideas.
A starting point.
But he also advocates a more patient, craftsman-like approach. Many top investors get interested when a stock price falls, not when it's soaring.
That contrarian idea again. Look at the 52-week low list.
Could be a good hunting ground, Buffett suggests. Published in the Wall Street Journal, Barron's. A place to start digging.
Digging into what?
Understanding the real owner earnings, the true cash flow, and looking at comparables, what similar companies have sold for in acquisitions. You find that info in annual reports, news databases. It's about finding real value others might be missing due to short-term noise.
Hard work, looking beyond the surface. Okay, briefly. Convertible securities and warrants. Graham's view?
Generally cautious. Convertibles, bonds, or preferred stock that can turn into common stock often trade at a premium price that already reflects that conversion option. It might make the underlying stock itself look less attractive at that price.
You pay for the option. And warrants?
Even more skeptical there. Warrants are options to buy stock. He felt they rarely benefit the company, complicate things, and companies sometimes lower the exercise price later, diluting shareholders. Can create imaginary market values, probably best avoided by most individuals.
Complexity often not worth it. He also mentions some speculative cautionary tales.
Yeah, Buffett brings up NVF Corp, AAA Enterprise, Ling Temco, VOD examples of companies that flew too close to the sun with excessive debt, accounting games, or just crazy expansion, reminders of the risks.
And the AOL-Time Warner merger, the sardine swallowing the whale.
A classic bubble-era example. AOL, the smaller internet company with a hugely inflated stock price fueled by hype, bought the much larger established Time Warner. Shows how market sentiment can drive deals completely detached from underlying economic value.
Market madness in action. Graham also used pairing comparisons of growth companies. What did those show?
From the late 60s or early 70s.
He compared, say, a home builder versus a healthcare company, H&R Block versus Bluebell Workwear, McGraw-Hill versus McGraw-Edison. What was the point?
To show you need to look deeper than just growth. Profitability ratios mattered. Home versus hospital. Sometimes the less glamorous stock was undervalued and did better. Bluebell. And even reasonably priced stocks can fall hard if earnings tank. McGraw's. It's about digging into the specifics, profitability, stability, resilience.
Don't just buy the story. And Buffett's pairings from the tech bubble era, Cisco, Yahoo, etc.
Those were stark. Cisco versus Cisco showed the risk of overpaying for tech growth versus steady food distribution profits. Yahoo versus Yum highlighted hype versus actual earnings. Commerce One, no profits versus Microsoft, huge profits, showed the danger of betting purely on potential. Palm versus 3Com showed how spin-offs can get wildly overvalued initially.
Vivid lessons about bubbles and fundamentals. Okay, shifting to dividend policy, what was Graham's take?
He noted stingy dividends often come from weak companies needing cash for debt or survival. That's one thing.
But what about mediocre companies hoarding cash?
He was skeptical if they kept earnings for expansion under the same management without a really compelling reason. Shareholders should question if that retained cash will actually earn a good return or if it should be paid out. Don't just assume retained earnings will be used well.
So, demand justification for retaining earnings if the track record isn't great. How about stock dividends versus stock splits? Are they different?
Technically, yes, historically. Stock dividends sometimes involved moving retained earnings to capital. Splits were more just changing the number of shares and price.
Well,
But
in practice now.
the lines are blurred. Both effectively increase the share count and lower the price per share. The main point, as we said, is neither inherently creates value for the shareholder. Still the same amount of pizza.
Got it. Now, the investor as shareholder, as owner. Graham's thoughts.
In theory, shareholders have the power. They own the company, elect the board.
But in practice?
Often very passive. They just rubber stamp management's proposals, even if performance is poor or pay is excessive.
So what should intelligent shareholders do?
Pay attention. Read the proxy statements, especially about executive compensation plans, stock options, oppose plans that excessively dilute ownership or reward mediocrity. Management should only get rich if the owners, the shareholders, are getting richer too through sustained good performance.
Be an engaged owner. Buffett mentions Enron here.
As a cautionary tale, the need to look past the surface, scrutinize financials, watch out for complex structures and related party deals, like the CFO's involvement with outside entities, demand transparency.
Dig deep. What about stock buybacks? Good or bad?
Can be good if the company buys back its stock when it's genuinely undervalued. That increases remaining shareholders' ownership percentage.
But sometimes companies do it wrong.
Buffett notes some, especially tech firms, tended to buy back more shares when the price was high and less when it was low. That's ineffective. The key is the price paid. Buying back cheap stock helps. Overpaying for your own stock doesn't.
Price matters, even for buybacks. Lastly, a quick word on taxes for investors.
Key things. Dividends usually taxed as ordinary income. Long-term capital gains, selling assets held over a year, usually taxed at lower rates. Capital losses can offset gains, and up to $3,000 of ordinary income per year with excess carried forward.
And funds pass through gains.
Yes, as capital gain dividends, usually taxed as long-term gains to you.
Okay.
And remember Buffett's tip. Avoid large fund purchases late in the year to potentially avoid taxes on gains you didn't participate in.
Good reminders. Okay, in a 1972 postscript, Graham looked back 40 years. How had the market changed?
Big shifts. Back around 1932, watered stock inflated asset values was a big issue. By 72, the concern was more about high valuations relative to book value.
And more focus on growth expectations driving prices.
Definitely. He also revisited an old idea. In the 20s, a good investment was also a good speculation because people ignored historical merit.
So fundamentals were cheap.
Often, yes. And attitudes changed. Early investors focused on safety and income dividends. Later, the focus shifted much more towards long-term capital gains.
And the paradox he noted.
By not focusing on future appreciation, the early investors almost guaranteed it through solid fundamentals. The modern focus on predicting the future and paying for it up front might not yield the same results.
Trying too hard to forecast can be counterproductive. So the challenge for modern investors.
Avoiding overpaying for quality and prospects, but also avoiding settling for poor quality just because the price seems cheap. It's finding that balance. Good business, good prospects, but always at a reasonable price with a margin of safety.
A perfect summary. Okay, for you, the learner, let's try to boil down these core principles from our deep dive.
First, success needs that sound intellectual framework and emotional discipline. Can't stress that enough.
Right. Be wary of market hype, expert predictions, focus on value, demand that margin of safety.
Understand investing versus speculating. Manage them separately. Protect against inflation's bite.
Don't just extrapolate the past. Have a disciplined portfolio policy, rebalance based on rules, not fear or greed.
Analysis is key. Forget simplistic ideas like buy what you know without the homework. Be cautious with IPOs and new issues.
Market timing. Probably futile. Focus on business value, not Mr. Market's daily moods.
Evaluate funds, carefully look at costs, risk, not just past returns. Learn basic analysis and valuation.
Be skeptical of earnings projections, accounting tricks. Understand splits, dividends. Be an engaged shareholder.
And always, always prioritize that margin of safety. It's the bedrock.
Absolutely. So here's a final thought to leave you with: the learner.
Considering these cycles of optimism and pessimism, the changing fads, how do you build an investment philosophy that stays grounded, resilient?
How can you consistently use the market's irrationality to your advantage without getting swept away by it yourself?
That's the ongoing challenge. Mastering that is really the key to long-term investing success and financial security.